Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be talking about Australia, a land abound in nature's gifts. You might have seen a few of our market deep dives of some interesting markets across the globe. Our Insights articles on India and Mexico shone a light on two emerging markets that are well positioned to benefit from global trends currently unfolding. Today, though, we'll be looking at the place that we at Simply Wall Street call home, Australia. For a country that is often seen as overrepresented in a lot of things, sport mainly, Australia has quite a subdued presence on the equity market stage. In terms of global equity markets, Australia is merely a drop in the ocean, coming in at only 1.5% of global market share. But this doesn't tell the full story of how interesting and unique the Australian economy is. So let's dive in and begin unraveling what makes Australia's market tick, what the risks are, and the global trends that Australia might benefit from. Before we get into that though, here's our quote of the week. Don't worry about the world coming to an end today. It's already tomorrow in Australia. Charles M. Schulz. Now, let's dive in. What happened in markets this week? Here's a quick summary of what's been going on. Firstly, the US imposes new tariffs on Chinese imports. Reuters. What's our take? The new tariffs on EVs, batteries, solar panels, semiconductors, and numerous other products are as high as 100%. The usual take on tariffs is that they are ultimately paid for by consumers. In this case, it's actually the Chinese government that is paying by subsidizing their exporters. A 100% tariff might sound steep, but some analysts point out that it's not high enough to offset the effect of these subsidies. We will now see how much China is prepared to spend, and can afford to spend, to keep its exports going. Secondly, Burberry reports a 34% drop in earnings as US and Asian consumers become price sensitive. Financial Times. What's our take? Burberry's revenue only fell 4% in the 12 months to March, but fell 12% in the last quarter. Q4 sales were down 17% in Asia and 12% in North America. In addition, the operating margin fell from 20% to 14% due to rising costs. Companies like Burberry are regarded as luxury goods companies, but they aren't as resilient as the really exclusive brands. With a broader customer base, they are more exposed to consumer sentiment as well as current fashion trends. Add rising costs to the mix and they are doing well to make a profit at all. Thirdly, credit card delinquencies are on the rise. Axios. What's our take? Speaking of consumer weakness, this new data from the New York Fed shows an increasing number of credit card delinquencies and aligns with our recent piece on how to invest around consumer weakness. Since 68% of the US's GDP comes from consumer spending, any weakness here can have an outsized impact on the broader economy. So, refer to our article above for how to hedge your portfolio against consumer weakness. 4. Raspberry Pi looking at UK IPO. Forbes. What's our take? If this listing goes ahead, it will give investors a new avenue for exposure to the Internet of Things, IoT, market. Raspberry Pi sells small, cheap computers which were initially popular amongst educators and hobbyists. They are now being widely deployed to remotely controlled devices in industries ranging from agriculture to security, supply chain management, and even space. The company's current shareholders include ARM Holdings and Sony, and it was valued at $560 million USD during the last funding round. 5. Investors pull billions from thematic ETFs. Bloomberg. What's our take? Bloomberg's reporting mirrors an article from ARK Invest on flows in Europe. ETFs that invest in clean energy, cybersecurity, EVs, digitization, and infrastructure are all seeing large outflows. These themes were all popular 12 to 24 months ago, but have fallen out of favor. On the other hand, cash is predictably flowing to AI, robotics, and automation ETFs. This is a very familiar pattern within thematic funds. Money flows in after a strong rally and then out after the inevitable decline. This is another reminder to be careful investing in themes when they are, quote, in fashion. 6. China issues $138 billion worth of bonds to support the economy. Financial Times. What's our take? These bonds were largely expected by the market, but investors weren't sure on the details. They will have durations of 20 to 50 years and they begin issuance on May 17th. The funds will likely be used to support the economy in areas where it's struggling, real estate, etc., and boost domestic demand by helping consumer confidence. Chinese officials, though, have said that the bonds will support the implementation of major national strategies as well as building security capabilities in key areas. So, interpret that as you will. And lastly, 7. US inflation data was better than feared. Reuters. What's our take? Investors were stoked to hear that inflation printed lower than expected. Granted, it was 3.4% versus 3.5% expectations, so the market rallied on the news. The latest inflation print boosted investors' hopes that the Federal Reserve might start its easing cycle this year. Considering the market had already rallied for the last 6 months, largely driven on the idea of rate cuts this year, and they keep getting pushed further out, investors might need to adjust their expectations, which could push the market lower. Now, let's talk about the land of abundance, Australia. No discussion about Australia's economy could be had without mentioning Australia's resources sector. Australia's resources are not just a cornerstone of the nation's economy, they also play a significant role in global infrastructure. The mining and resource sector directly contributes approximately 14.3% to the nation's GDP, the largest contribution, ahead of the health and education sectors at 12.8% and the financial services sector at 7.4%. The mining and resource operations are heavily concentrated in regions rich in natural resources, such as Western Australia and Queensland. The country ranks as the world's leading exporter of key commodities like coal and iron ore, of which Australia accounts for 55.4% of the global supply. Australia is also increasing exports of important rare earth elements and other minerals critical for modern technologies. With that in mind, let's talk about how Australia is fueling the global energy transition. As the world shifts towards renewable energy sources to meet net zero targets in the fight against climate change, Australia's role in the global market becomes increasingly pivotal due to its vast reserves of key battery minerals. Many of the minerals found in abundance in Australia's earth are essential for battery production, which powers everything from electric vehicles to renewable energy storage solutions. If we keep tracking down the path set to meet 2050 emissions targets, we could expect the demand for these minerals to climb, underscoring Australia's importance as a key supplier in the global supply chain for green technologies. This would create opportunities for investors, foreign or domestic, to capitalise on the nation's wealth of resources. Australia holds a dominant position in the market for the 3 main battery metals. 1. Australia is the world's largest supplier of lithium, producing some 46.9% of the world's total supply. Although Chile has larger known reserves, issues with legislation, water scarcity, and indigenous groups have prevented expansion to the levels of production we see in Australia. 2. Australia is the 5th largest nickel producer globally, accounting for roughly 6% of the global supply. There is even scope for greater levels of production, considering Australia's reserves are the 2nd most expansive in the world at 20.6% of the global reserve. And thirdly, Australia is the 3rd largest producer of cobalt at 3.5% of the global supply. Although Australia lags significantly behind the Democratic Republic of Congo in first, ethical concerns over the use of child labour in artisanal mines could see demand shift to countries with far greater worker protections, like Australia. Australia could be an opportunity for global investors seeking exposure to resources like iron ore or battery metals, particularly as ESG concerns and sovereign risks may deter investment in other resource-rich regions like Africa or South America. Now let's talk about uranium. Is Australia about to have a glow-up? It's not just battery metals that Australia has an abundance of. Australia also holds expansive reserves of natural gas and uranium. As touched on last week, the rising uranium price has piqued the interest of investors in Australia's market. Australia's uranium reserves are the largest in the world, hosting as much as 1/3 of the world's known uranium resources. However, Australia is only the 4th largest producer of uranium. Decades of aversion to mining uranium embroiled with post-Cold War fear has meant that Australia's uranium mining industry is somewhat underdeveloped. Australia's export of uranium is limited to countries with which Australia has formed a bilateral nuclear cooperation agreement with, and the exports must explicitly be for peaceful non-explosive purposes. However, the requirement for these agreements does not seem to limit Australia's exports capacity, with agreements already struck with countries with significant nuclear arsenals like Russia, China, France, and the United States. Enforcing that agreement might be a bit hard. In addition, Japan, Australia's 2nd largest trade partner, added uranium to its critical minerals list. While it's not clear if Australia will dramatically increase its production of uranium to meet rising demand, this is an indication that the opportunity is there for investment, since demand is rising. Globally, the uranium tide seems to be turning in recent years. The UN Climate Change Council declared a need to triple global nuclear capacity to meet 2050 net zero targets. So, if the narrative globally continues to become more favourable to nuclear power, then the industry might enjoy more favourable political and societal conditions. This all sounds great, but what's the catch? Is Australia really an investor's paradise? Australia does have a lot going for it, and we may be biased here. Here's a few things it does have. It does have a vast supply of critical mineral reserves, the magnitude and breadth of which are unrivaled globally. It has a largely stable and cooperative weather climate which lends itself to consistent project operation in the area, which not all resource countries can claim. And it has a relatively stable political landscape with a legal framework familiar to investors in the United States and the United Kingdom. So, what is the catch? Well, like any country, there is always some level of sovereign risk, so let's take a look at some of the risks investors should be aware of. The risk of relying on one big trade partner. Australia's economic landscape is significantly influenced by its trade relationship with China, its largest trading partner. In the 2022-23 fiscal year, two-way trade with China totaled 316.9 billion AUD, with Australia's goods and services exports to China encompassing almost two-thirds of that total, 203.5 billion AUD. If you've made it this far, the makeup of these exports should come as no surprise. Iron ore is far and away the largest export with China, importing 104.8 billion AUD worth, followed by natural gas with exports totaling 20.8 billion, closely followed by crude minerals at 19.8 billion AUD. While having such an expansive trade relationship is important, providing support to Australia's mining sector, as well as other key segments like agriculture and education, it does highlight a significant risk. The reliance on Chinese demand could upend Australia's entire economy if the stability of the trade relationship was jeopardised. Be it from political tensions or simply macroeconomic turmoil, a significant decline in demand for Australian exports from China could spell disaster if these industries are unable to redirect supply to other foreign trade partners. While the relationship between China and Australia is currently fair, there have been moments recently where the relationship has been tested, a not-so-rosy relationship. Despite the economic benefits, the relationship between Australia and China has been fraught with strategic and diplomatic tensions over the years. The issues range from cybersecurity concerns to trade tariffs and restrictions. On the cyber front, the Australian Signals Directorate had pointed the finger at China over a spate of malicious attacks on Australian companies and infrastructure. As for trade tariffs, following the pandemic, China placed a number of tariffs on Australian exports, like wine, where tariffs were raised to 200%, and barley. Further biosecurity restrictions impacted Australia's agricultural sector, with several beef abattoirs sanctioned and timber exports blocked, in addition to the bans on the export of coal, cotton, and lobsters. As a result of these trade restrictions, Australia's exports of certain goods to China fell to nearly zero. The impact of the restrictions was economically significant, as Australia's exports to China fell from 33% of Australia's total export market to 27.6% in 2022. As of late though, the relationship has achieved some form of stability. The last of the trade restrictions between Australia and China was lifted in March of 2024, as China abolished the tariffs placed on Australian wine exports. While the relationship of these restrictions can be read as an improving trade relationship between the two countries, it could also be argued that the futility of the restrictions meant they were no longer necessary. This is because the heavy tariffs did little to hurt Australia's overall exports, as the goods were simply redirected to other markets. What could have originally been seen as political retribution ended up as being merely a slight inconvenience. This is encouraging from a risk mitigation point of view, and shows that should the relationship sour, Australia could potentially soften the blow by benefiting from the global trends of friendshoring for its exported goods. When assessing the inherent risk of investing in Australia, it's not just Australia's relationship with China that has to be monitored. China's trade relationships with other countries could also have a significant bearing on the Australian economy. As stated at the beginning of this market insight, the US imposed tariffs on exports of Chinese EVs, batteries, solar panels, and semiconductors as a reaction to the Chinese government heavily subsidizing these industries. While there's no direct impact, if China stops subsidizing these industries and demand for Chinese products falls due to higher prices, that will inevitably be passed on to consumers. Then the demand for the raw materials mined in Australia could also fall. Now let's talk about a blossoming tech landscape. Believe it or not, there's much more to Australia than what can be dug out of the ground. In fact, Australia is undergoing somewhat of a tech boom, which has spurred rapid growth in employment and investment. The tech landscape in Australia was previously considered quite underdeveloped, but following the increase in digital adoption throughout the COVID-19 pandemic, things have begun to change. Employment within Australia's tech industry has been hot, with the number of tech jobs rising 3 times faster than the rest of the economy, and the industry has now become a fundamental pillar of the Australian economy. What was once a drop in the ocean has now become the 3rd largest contributor to Australia's economy, adding 167 billion AUD when you account for both the direct and indirect contributions to GDP. The growth has been exponential as well, with the sector's contribution to Australia's GDP increasing 79% since 2016, growing 4 times faster than any other industry. While this growth has been phenomenal, there's still plenty of opportunity for it to keep growing, as the direct impact of the tech sector on Australia's economy is still relatively small. If we only assess direct contribution, the tech sector accounts for 3.8% of Australia's GDP, far lower than what we see in other developed economies like the US, 10.2%, the UK, 8.1%, and Canada, 6.8%. There have been numerous tech success stories originating from Australia, and the hopes are that an education and business environment conducive to growing the technology sector encourages a transformation of Australia into a tech hub akin to Silicon Valley. For a closer look at some of these success stories, here are some of the big names in tech that have started in Australia and New Zealand. From the publicly traded, we've got Atlassian, Xero, Afterpay, which was acquired by Block, WiseTech Global, Computershare, and REA Group. To the privately listed ones you may have heard of, there's Canva, Airwallex, Stake, and VGW. So, what's the insight? Investing in Australia is a lesson in global politics and economics. Australia's unique economy comes with its own unique challenges. Its dependence on a heavily cyclical industry that interacts with a volatile trading partner means that there are distinct periods of boom and bust. While the severity of this largely depends on the sector you're investing in, it's still incredibly useful to carry forward the same knowledge irrespective of if the industry is heavily correlated with exports, e.g. mining, agriculture, education, or if its focus is more domestic, like the financials, health, or construction industries. Here are some tips if you're considering investing in Australia, or any country where there's a heavy reliance on exporting to foreign partners. Firstly, keep a close eye on geopolitical relations. US relations with key Australian trade partners can have an unexpected domino effect, which could hurt or be a boon to the Australian economy. It's important to be aware of any trade restrictions or agreements that could materially alter the demand for the goods and services Australia provides. 2. Understand who the key trade partners are. An overwhelming majority of Australian exports made their way to Asia, but this seems to be changing over the last few years as more exports made their way to the Americas to try and reduce reliance on a single region. Be sure to remain aware of which countries have close ties with Australia and the factors that could impact the demand for Australian goods and services, be that political or economic. 3. Find patterns or correlations in the demand for goods and services. Generally, a downturn in Chinese property development negatively impacts Australian iron ore exports. Likewise, tension and war in other regions have elevated the demand for Australia's agricultural exports. There are often links like this that can be made that can help you understand when periods of boom or bust are likely. 4. Look for global opportunities. Australia is typically considered less risky than global competitors in Africa and South America. Instability and uncertainty in those regions could see investors shift to Australia to meet shortfalls in supply due to its relatively more stable political environment. And lastly, seek new horizons. Australia's economy is heavily focused on mining, education, and financials, but don't ignore opportunities that are arising in its growing tech landscape. For those who are interested, here are some of the sectors that define Australia's economy and some of the major players in those respective industries. Firstly, mining and resources. BHP Group, Fortescue Metals, and Woodside Energy Group. Financials, Commonwealth Bank of Australia, National Australia Bank, and Macquarie Group. Healthcare, CSL, Cochlear, and Sonic Healthcare. Retail and consumer services, Wesfarmers, Woolworths Group, and Aristocrat Leisure. Now, let's wrap up with the key events during next week. On Tuesday, Canada's inflation rate will be published, with economists expecting 2.8%, down from 2.9%. On Wednesday, Japan's balance of trade data will be published. The most recent surplus was 366.5 billion yen. The UK inflation data is also due to be released. The annual rate is currently 3.2%. The minutes from the last FOMC meeting will provide more detail on the committee's stance on inflation and interest rates. And on Friday, Japan's inflation rate, currently 2.7%, is due to be published. The UK retail sales are forecast to be up 0.3% for the year to April, up from 0% in March. And US durable goods orders are expected to be just 0.3% higher month on month, down from 2.6% in March. This week's big event will no doubt be Nvidia's earnings report on Wednesday. Elsewhere, earnings reports are due from retailers and cloud software providers, amongst others. So some of those names include Nvidia, Palo Alto Networks, Zoom Video, Intuit, Snowflake, Target, Dollar Tree, and PDD Holdings. That's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.